Hi all, we have already done the weak and strong form of efficient market hypothesis, and in this presentation we will continue with semi-strong form of market. Semi-strong form of efficiency is a type of efficient market hypothesis which holds that security prices adjust quickly to newly available information, thus eliminating the use of fundamental or technical analysis to achieving a higher return. The semi-strong form of efficiency does not use historical prices, trading volume, rates of return, earnings, dividend payments, profitability ratios, stock splits or any other element of fundamental analysis. The hypothesis under this assumes that investors who trade their securities based on newly available information should expect an average risk rate of return. And in order to outperform the market, the investors are ready to take higher level of risk. Few important things about semi-strong form of efficiency to be kept in mind is that the price of a stock is dependent on its publicly available material information. It also suggests that fundamental and technical analysis are useless in predicting the stock future price movement. Only material non-public information is considered useful for trading, and this concept can be better explained with the help of an example. Now let us assume that the price of a stock of ABC company is 30 rupees per unit on a day, and on next day the company is required to release its annual financial report. Now before the release of the report, there was a rumor in the market at the later hours of the day which came to be that the company has managed to have a great year with high financial returns. As the rumor was positive, so this will lead to increase in the price of shares of ABC company to rupees 40 per share. However, the next day, after the financial report is made available, it is seen that the company has indeed suffered a financial decline, and this pushes the price back to rupees 25. Now, the rumor which will lead to increase in the price of a stock to rupees 40 is publicly available information, while the actual news due to which the price will fall to rupees 25 is material non-public information. Now, investors who purchase the shares at rupees 30, if they have any idea about the material non-public information before the release of the statement of financial return, if they sell the shares, then definitely they would earn great amount of profit. Also the investors who purchase the share at rupees 40 because they thought that the price will rise further also, and because of that wrong rumor, and they suffer a huge loss after the release of the statement and material non-public information. To test the semi-strong form of market efficiency, there are two most popular methods. First is event study method and second is portfolio study method. An event study method is designed to examine the market reactions to and excess returns around the specific information events. This method examines how fast the stock prices adjust to specific significant economic events. And the information events can be market-wide, such as macroeconomic announcements, or firm-specific, such as earning or dividend announcements. In order to test the semi-strong form of market, the event study method is conducted, and it comprises of 5 steps. The first step includes that the event to be studied is clearly defined and the date on which the event was announced. The presumption is that the timing of the event is known with a fair degree of certainty. Since the financial markets react to the information about an event rather than event itself, most studies are centered around the announcement date of the event. Once the event dates are known, returns are collected around these dates. And while doing so, 2 types of decisions have to be made by the analyst. Now, first decision is to decide whether to collect the returns weekly or daily. And the second decision is to determine how many periods of returns before and after the announcement of date will be considered as a part of event window. The returns are adjusted for market performance and risk to arrive at the excess returns for each firm in the sample. Next step is to compute the average excess returns across the firms. And the last step includes assessing the excess returns around the announcement date and to see whether they are different from zero or not. And in order to check this, we have to divide the average excess return by the standard error. Second method to test the semi-strong market is portfolio study. It is also known as return prediction study. A portfolio study examines the possibility of earning superior risk-adjusted returns by trading on an observable characteristic. This characteristics can be price-earning ratio or dividend yield or anything else. In some investment strategies, firms with specific characteristics are viewed as more likely to be undervalued, due to which it was shown that they have excess returns than those firms without these characteristics. So in these cases, the strategies can be tested by creating the portfolio of the firm possessing these characteristics at the beginning of the time period and then examining return over the time period. To ensure that these results are not inflated, the process is repeated number of times and for number of periods. There are 7 steps in portfolio studies. The first step includes defining the variable or characteristics on which the firm will be classified. Like as discussed earlier, it can be price earning ratio or dividend or the market value of equity, etc. In next step, the firms are classified into portfolios depending upon the variable. Like if price earning ratios is the screening variable or characteristic, then the firms are classified on the basis of price earning ratio from lowest price earning to highest price earning ratios. In next step, the return for each portfolio is calculated. In case of single factor model, beta, and in case of multiple factor model, betas are estimated. Then excess return is calculated for each portfolio in combination with the standard error of the excess return. In next step, an analyst has to assess whether the average excess returns are different across the portfolios. And as a final test, the extreme portfolios can be matched against each other to see that there are differences across these portfolios or not. This is all about the topic of semi-strong form of market efficiency. Thank you very much and keep